Are you aware of the significant changes in Thailand's tax system that came into effect on January 1st, 2024? This is a question that has left the expat community wide-eyed and wondering. A major shift in the Thai tax landscape has introduced a new reality for expats, one that has stirred up a mix of anxiety and curiosity. Once a sanctuary for foreign income, Thailand's tax code was a sweet deal for expats. Foreign earnings kept outside Thailand remained untaxed, allowing expats to enjoy a financial advantage that few other countries offered. But as the calendar flipped to 2024, a new tax dawn broke over the land of smiles. Now, all foreign earned income brought into Thailand by tax residents, including expats, is subject to personal income tax. This significant shift has left many expats scratching their heads, wondering how to steer through this unexplored territory. So, what exactly has changed? To understand the full impact, let's take a quick trip down memory lane. Before 2024, expats could keep their foreign income untaxed as long as it remained outside Thailand. Income earned and brought into the country within the same year was subject to tax, but passive income from abroad, like pensions and investments, existed in a gray area with no clear rules. But 2024 has painted a very different picture. The new law now states that all foreign earned income remitted to Thailand by tax residents is subject to personal income tax. The tax rates are progressive, starting at 0% for income up to 150,000 baht and climbing to a hefty 35% for income exceeding 5 million baht. With the new tax landscape laid bare, expats are now seeking solutions to minimize the impact of this new tax reality. But fear not, there are potential pathways to navigate this maze and shield some of that hard-earned income. Let's dive deeper into what these changes mean for expats living in Thailand. We'll explore the intricacies of these new rules and unlock potential strategies to secure your financial future in the land of smiles. Stay tuned, and let's decode this tax tango together. To fully comprehend the impact of these changes, we need to rewind to the pre-2024 era. Expats then had the liberty of keeping their foreign income untaxed as long as it stayed outside Thailand's borders. Income earned and brought into the country within the same year was subject to tax. But passive income, like pensions and investments from abroad, existed in a gray area with no clear guidelines. Let's imagine a time when Thailand's tax code was akin to a sweet deal for expats. You could earn abroad, stash your earnings outside Thailand, and enjoy those earnings untaxed. This freedom provided a financial cushion that many expats relished. But then, as the clock struck midnight on December 31st, 2023, things took a dramatic turn. The new year ushered in a paradigm shift. With the overhaul of the Thai tax system, the financial landscape for expats underwent a seismic shift. From January 1st, 2024, all foreign earned income brought into Thailand by tax residents, including expats, is now subject to personal income tax. This significant departure from the past has left many expats wondering how to navigate this uncharted territory. Now let's dive into the specifics of the new tax laws. The tax rates are progressive, starting at a comforting 0% for income up to 150,000 baht. However, for income exceeding 5 million baht, the tax rate climbs to a hefty 35%. That's a significant chunk of income that could be heading straight to the taxman's pocket. And what about pensions, you ask? While pensions are taxed in Thailand under the new law, there may be some relief through double taxation agreements with the home country. This means that, depending on the agreement, you may not be subjected to tax twice on the same income. So in essence, the old tax landscape was like a vast open field where foreign income could roam free, unhindered by Thai tax laws. But now, in 2024, that open field has turned into a maze, with new tax laws forming the walls that can seem insurmountable. However, it's not all doom and gloom. The new tax laws, while more stringent, also offer certain pathways that can be navigated to minimize the tax burden. But it would require some savvy financial planning and understanding of the Thai tax system. As we journey forward in this new tax landscape, it's crucial to remember that change, while often challenging, also brings opportunities. Opportunities to learn, to adapt, and to find new ways to secure our financial future. As we close this chapter on understanding the old and the new, let's look ahead with optimism and resilience. After all, every maze has an exit. In the next part of our journey, we will explore the potential pathways that can guide expats through this tax maze. So, stay tuned as we delve deeper into the intricacies of the Thai tax system. Let's explore how expats can navigate this new tax landscape. With the new tax reality sinking in, expats are exploring solutions to minimize its impact. A quick glance at the Thai tax laws reveals a labyrinth of rules and regulations. But fear not. We're here to help chart a course through this tax maze. First up, let's talk about the gift of the givers. Now, this isn't some secret society. It's a generous exemption in the Thai tax law that allows a spouse to gift up to 20 million baht in a single year, tax-free. That's right. Not a single baht handed over to the taxman. This could be a strategic move for couples looking to transfer income and potentially lower their overall tax burden. However, tread lightly. If you exceed this 20 million baht threshold, a flat tax of 5% swoops in. So, plan wisely. Next, let's turn our attention to the royalty with relief. Sounds regal, right? It's actually a reference to Royal Decree number 743. This decree could be a game changer for some expats. It grants tax exemptions to specific long-term visa holders, including wealthy retirees, global citizens, and professionals working remotely from Thailand. These lucky individuals could potentially shield their offshore income from the taxman's claws. But wait, there's more. Highly skilled professionals in targeted industries can enjoy a reduced flat tax rate of 17% on their employment income. That's a significant drop from the standard progressive rates. But how do you unlock these potential tax havens? Well, it's not as simple as turning a key. Eligibility for these benefits hinges on several factors. You need to hold a long-term resident visa. Think of this as your passport to the exclusive tax relief club. You also need to meet the Thai Board of Investments criteria. Each visa category comes with its own set of qualifications and conditions. And for professionals, you must be working in a targeted industry. Not all industries qualify, so ensure you check the list carefully. Lastly, transparency is fundamental. Declare your employment details to claim the reduced tax rate. Navigating the tax maze isn't a walk in the park, but with the right information and strategy, it's doable. And remember, when in doubt, seeking professional advice is always a good idea. Now, let's look at how expats can unlock these potential tax reliefs. navigating the tax maze requires understanding how to unlock potential tax havens. So let's dive right into it. The Royal Decree number 743 is like a treasure map, leading eligible expats to potential tax havens. But just like any treasure map, you need to meet certain criteria to find that elusive X that marks the spot. First, you need to be holding a long-term resident visa, or LTR. Think of it as the key to an exclusive club. Only with this key can you unlock the benefits of the decree. Now, that's not to say that every LTR holder automatically gets a free pass. It's just the first step. Next, you need to meet the Thai Board of Investments criteria. Each visa category comes with specific qualifications and conditions set by the board. It's a bit like a secret handshake. You need to know it to be part of the club. So, make sure you check the specifics for your visa category. Now, if you're a professional working in Thailand, there's another layer to this. You need to be working in a targeted industry. Not every job will qualify for the tax exemption. So, check the list of targeted industries carefully. You don't want to miss out because you overlooked this detail. Lastly, and perhaps most importantly, you need to declare your employment details. There's no room for ambiguity here. The Thai tax authorities value transparency. So, if you're hoping to enjoy the benefits of a reduced tax rate, you need to be clear about your employment status and income. Remember, trying to outsmart the system isn't a smart move. It's about playing by the rules, not bending them. Now, keep in mind that while these exemptions and benefits can potentially shield some of your income, they are not a magic wand that will make all your tax liabilities disappear. They're tools to help you navigate the tax landscape more effectively, not shortcuts to bypass it. Also, it's worth noting that while these potential tax havens can offer significant relief, they come with their own complexities. Navigating these waters can be tricky, and one wrong move can land you in hot water. So it's always a good idea to seek professional advice. A tax consultant or financial advisor can guide you through the process, helping you make informed decisions and avoid potential pitfalls. The tax landscape in Thailand has certainly changed, but with careful planning and a clear understanding of the rules, expats can still find ways to protect their hard-earned income. The key is to stay informed, plan strategically, and navigate the complexities with caution and clarity. So remember, while the tax maze may seem daunting, it's not impossible to navigate. With the right knowledge and guidance, you can find your way through it and unlock the potential benefits that await. Transparency and careful planning are key to claiming reduced taxes. Let's recap the key points discussed today. The year 2024 has brought about a significant shift in the Thai tax landscape, especially impacting the expat community. The once tax-friendly haven for foreign income has become a tax maze, with the new law imposing personal income tax on all foreign-earned income remitted to Thailand by tax residents, including expats. The progressive tax rates range from 0% for income up to 150,000 baht to a substantial 35% for income exceeding 5 million baht. We also look back at the pre-2024 era when expats had the liberty of keeping their foreign income untaxed as long as it remained outside Thailand. Passive income like pensions and investments from abroad existed in a gray area with no clear guidelines. However, this has changed, and the new law now clearly dictates the taxation rules. But it's not all doom and gloom. We explored potential strategies to navigate this new tax reality. For instance, Thai tax law offers an exemption on gifts between spouses, up to 20 million baht in a single year. This could be a strategic avenue for couples to transfer income and potentially lower their overall tax burden. We also discussed Royal Decree number 743, a potential golden ticket for certain long-term visa holders, including wealthy retirees, global citizens, and professionals working remotely from Thailand. These individuals can potentially shield offshore income brought into the country from the taxman's claws. Highly skilled professionals in targeted industries can also enjoy a reduced flat tax rate of 17% on their employment income. However, to unlock these tax havens, several eligibility criteria need to be met, including holding a long-term resident visa and meeting the Thai Board of Investment's specific qualifications and conditions. For professionals, working in a targeted industry is also key. The tax landscape in Thailand has indeed transformed. But by staying informed and planning wisely, expats can navigate their financial future in this new reality. Stay informed and plan wisely to navigate your financial future in the land of smiles. Don't forget to hit that like button and subscribe for many more information-packed videos. Let us know you subscribed in the comments section.